Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, September 17th, 2025. It's a big Fed day, so we're excited about that. But before we get into that, as always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, or to get on the right side of market risk to the extent you have been following KISS or Dr. Mo, you need to be a client of 42 Macro. So today's key macro question is, will today mark the beginning of the end of Fed independence? Our answer, no. Based on our careful analysis of the commentary from the growing list of Fed chair candidates, it is highly unlikely that Fed independence will end on an investable time horizon. What is more likely to occur is a much needed erosion of Fed independence that forces the institution to combat the K-shaped nature of the US economy rather than continuing to perpetuate. All told, the Fed's well-telegraphed decision to resume cutting rates later today, with inflation above their arbitrary 2% target, represents a much-needed step in the right direction, according to our global thought leadership on the subject. The three key dynamics to watch for in today's FOMC event are as follows. Number one, will the median FOMC member speed up their projected path to return the policy rate to a neutral setting of around 3%? Number two, will the median FOMC member decrease their estimate of NAIRU, the non-accelerating inflation rate of unemployment, or signal a greater uncertainty surrounding their long-term unemployment rate forecasts due to broad AI adoption? And number three, will the median FOMC member lower their estimate of the neutral rate while also extending the time horizon for a return to their arbitrary 2% inflation target, or perhaps increase their long-run estimate of inflation altogether, which will be a tacit acceptance of fiscal dominance? Based on our careful analysis of recent key economic data and forward guidance, number one seems likely today, number two seems plausible today, and number three seems highly unlikely. In our data-driven view, number three seems highly likely. My apologies. In our data-driven view, number three seems highly likely to occur over the long term. Investors who rely on philosophical and/or statutory arguments against the upcoming erosion of Fed independence during this foreturning are likely to continue dramatically underperforming those who do. Total return since we first published our investing during a foreturning regime presentation in September of 2023, we got stocks up 52%, gold up 91%, and Bitcoin up 345%, while Treasury bonds and the dollar only up 5% and 3% respectively. The only thing more hazardous to your financial health than fighting the Fed is fighting the market. We are proud to support the thousands of highly informed investors around the world who are relying on KISS and Dr. Mo to help them do the opposite. Transitioning to our 42 Macro dashboard, as always, we wrap up with a question from our community. This one's titled Too Much Conviction. It says, hi all, I'm new to 42 Macro and truly love what Darius is doing. As a retail investor, it is incredibly useful to have access to tools like Dr. Mo. Whilst I fully buy into the paradigm C into paradigm D narrative, I wonder whether the level of conviction presented creates a false certainty about what feels to me like an uncertain setup. It seems to rest on the basis that governments are almost omnipotent in directing the economy. Retail sales are holding up almost exclusively to the top 20% of the population who also own the stocks. If something triggered a sell-off, a question emerged on the AI theme, jobless claims jumped more than expected, the sell-off could be brutal, which might become self-fulfilling if those consumers then pull back the spending. I have no doubt that the government and Fed stimulate in that direction, but look at past asset bubbles, 1929, Japan in the late 80s, and the deflationary impact is immense. What if governments repeatedly underestimate the amount of stimulus required to juice the economy, and it takes years to arrive at paradigm D with an intervening brutal recession? How can that be discounted? I know we say Dr. Mo has our back, but it will not have seen the bursting of an asset bubble on such a scale, so we cannot be sure. I think you will ultimately be right long term, but I personally think it will be helpful to hear risks to the main thesis than I have discussed, more than I have thus far. So, fantastic question. This is the kind of question I spend all week answering in institutional client meetings. Literally just left the institutional client meeting that went 20 minutes over answering questions like this. So I'm super pumped to have these kind of questions in our community chat so that we can ask and answer, emphasis on we, not just me, myself, but we also have thousands of other investors around the world, all across the sophistication spectrum, trying to get to the right answers together faster than the investors outside of this community so that we can buy what needs to be bought before they do or sell what needs to be sold before they do, rinse and repeat for a long period of time. So a couple things I'll say on this. Number one, I think it's always very important to remind investors what it is that we do here that is very different from a risk management perspective at 42 Macro relative to what I think the person who asked the question is used to doing and or seeing as an investor. The number one thing we do is to help you identify and position for the market regime. We do that by nowcasting the market regime with our global macro risk matrix market regime nowcasting process, very sophisticated quantitative risk management signaling tool. And then we filter those quantitative risk management signals to retail investors via KISS, and we filter those quantitative risk management signals to institutional investors via Dr. Mo. 100% of the decisions we make in our portfolio, or 100% of the decisions that we communicate for investors to make in their portfolios from an asset allocation or portfolio construction standpoint, stop and start with this process here. Everything we say, including Paradigm C, Paradigm D, is only said with the intent to help you understand what that full distribution of probable economic outcomes is, so that when the market decides it wants to stop pricing in the right tail risk associated with the Paradigm C theme to pricing in the intermission between Paradigm C and Paradigm D, or a move back towards bearish Paradigm B, we are comfortable in understanding why that is occurring, when it is occurring, so that when KISS and Dr. Mo puts those signals in your inbox or on our client dashboard in the signal section, you feel confident as an investor on Team 42 to just dispassionately execute the signal in your portfolio, so that you can remain on the right side of market risk, whether it be right tail risk or left tail risk. That's our process in a nutshell. That's very different than how most investors invest. Most investors do a bunch of fundamental research, come up with a fundamental research theme, and put on a bunch of positions associated with that research theme, and they don't change those positions until they're proven wrong on that fundamental research theme. This is what we mean by the slide here. How most investors, manage risk. They're responding to failed predictions. How we manage risk is we don't invest on the basis of fundamental research predictions at all. Nobody on earth has been more right than Darius Dale has been on global financial market risk with his fundamental research views than I have this year. We called the kitchen sinking and then the crash, and we immediately called right after the crash for the Paradigm C thing. No, I mean, this has been the most right I've ever been from a fundamental research perspective, and 0% of those fundamental themes have impacted my portfolio or the portfolio of the thousands of investors that are following KISS and Dr. Mo, because the only thing that matters to my portfolio and the portfolios of the thousands of investors following KISS and Dr. Mo are the KISS and Dr. Mo signals, because they are better at timing markets, big swings in financial markets, than I am, who is a human being who might get wedded to his fundamental themes. Now, coincidentally, I do not get wedded to my fundamental themes. And the reason for that is we run an institutional research and risk management process. On the research side of things, one of the things that we do that is core to our monthly research process. We have a daily research process in terms of the lead off morning note. We have a weekly research process in terms of summarizing all the stuff that's changing at the margins that we need to pay attention to as investors in the Around the Horn every Saturday. And then every month, right after the jobs report, we publish this presentation here, which is our macro scouting report. And in that macro scouting report presentation, the meat of the presentation, the main event, is the modal outcome, right tail risk and left tail risk themes. And so, going back to the question, it sounds like the person who asked the question has not yet reviewed any of our macro scouting reports, because we literally spent from slide 21 to 132, so more than 100 slides on painting the full distribution of probable outcomes. Obviously, we're incredibly bullish. We've been 100 percentile bullish since May 3rd across global Wall Street in the context of our Paradigm C thing. That's our modal outcome thing. We've been 100 percentile bullish, but we recognize that, hey, there are even upside risks relative to that, and more importantly, there are plenty of downside risks relative to that we highlight in our right tail risk section and in our left tail risk section. And so you have to understand that, if you're not seeing everything that we're doing here behind our paywall, that's totally fine. But the assumption that you're taking investment advice from someone who's going to be blindly wedded to his fundamental research themes is an incredibly incorrect assumption. The only thing that guides our investment decision-making process are KISS and Dr. Mo. Everything else we talk about with regards to Paradigm C, our resilient U.S. economy theme, our sticky inflation theme, what was our triple S's theme prior to that, before we invented the Paradigm C theme, all the other themes that we've created that, front run the positioning cycle on global Wall Street for the past half decade. All those themes are purely designed with the express intent and only to help you understand what this full distribution of probable economic and market and policy outcomes are. And so wrapping up, sort of answering the question, are we concerned that I might have a little bit too much conviction in Paradigm C? The short answer is you never have to be concerned that I have too much conviction in anything, because at the end of the day, KISS and Dr. Mo, which are high quality institutional grade risk management overlays, are going to do their job to keep us on the right side of market risk. Will they ever sell the exact top or buy the exact bottom? No, they're not, because they're trend following in nature. However, they've proven for half a decade, or not quite a half a decade, but they've proven for two and a half years now in Dr. Most terms, 3 years now in Kiss's terms, that they're significantly more effective than what most investors are doing out there from a risk management standpoint, in terms of being able to access this quality of risk management overlay at these price points. Obviously, there are significantly better risk management overlays across the global buy side, but you're not going to be able to access them at these price points. Certainly, as a retail investor, or as an investment advisor, or even as a small hedge fund or family office. So I would highly recommend that you partner with us if you want to be on this journey with me. And if you don't, we just appreciate you for tuning into these macro minutes every day. So I'll let you guys go here, and best of luck today, Jay Powell. Hopefully you get it right up there. I'll catch you back here tomorrow. Cheers.